It's a privilege for me to participate in this Finance Malta conference dedicated to the very important topic of the new challenges and opportunities that the financial and banking sector will face through the ongoing restructuring process, which is unfolding with the new regulatory and supervision framework. The financial crisis we have experienced since 2008 has indeed changed the previous scenario for the financial sector, questioning its relationship with the economic growth, the role of monetary policy, the need of a new system-wide perspective on financial stability, together with the improved international cooperation and the striking evidence that contagion in the global financial market is easy to spread out. New challenges, new regulation and supervision, and a better focus on financial system are the new world in front of us. But before discussing on where we currently stand, it would be very useful to recall the economic situation and the trend before the financial crisis. Before 2008, our economies experienced almost 2 decades of positive and robust growth. The so-called Great Moderation gave us a noticeable reduced macroeconomic volatility, a sustained growth of the world economy, a constant reduction of the inflation rate, and increased productivity in all the new economic sectors, abundant liquidity, large and persisting profits for financial entities with historically low risk premium, and consequently an improving expectation about asset prices, particularly noticeable in house prices. Financial innovations was favored in this environment of progressive globalization of financial markets with a relatively light regulation and supervision. The positive expectations enhanced the potential economic growth and allowed the economic expansion with periods of relative moderate recessions, which were at the end beneficial for the consumers and producers. We have seen in this period a better fiscal discipline in public finance, a reduction of inflation rate, and a generalized growth of employment, which created, don't forget, in the Eurozone, 18 million of new jobs. Unfortunately, these benefits were confronted by large and persisting current accounts deficit in the United States, where in particular, households showed low saving rates, confronted by the opposite trend in the emerging markets. Between 2001 and 2007, global gross saving grew from 21% of GDP to 24%, and much of this increase reflected a better marginal propensity to save, we're talking about 43%, in emerging countries. In contrast, the average saving rates of the industrial countries fell, notably in the United States, while capital spending shifted towards residential constructions. Credit growth in the United States, mainly for mortgages, went from 4% in 1990 to 7.5% in the period 2000-2006. Since the year 2000, property prices went up 90% in UK and Spain and 60% in USA, while the contribution of this sector to the GDP represented 6% for the USA, 9% for Spain, and 12% for Ireland. The wealth effect, due to property prices, favored consumers and was instrumental for expenditure on durable goods, which led to a build-up of production capacity. US current account deficit rose from 3% of GDP in 1990 to a peak of 6% in 2006. By 2007, current accounts surpluses as percentage of GDP soared to 10% in China, 8% in Germany, and 5% in Japan, all major exporters of manufactured goods. In the Middle East, current account surpluses rose, driven by higher oil prices. For these and other industrialized nations, USA demand was one of the major drivers of the overall growth. However, global imbalances were accompanied by an undervaluation of risk taken, an excessive optimism, which most of the time is not a wise approach to reality, excessive financial leverage, a research for legislation arbitrage, which intended to exploit loopholes in the financial system, and the lack of transparency for the interests involved and for the financial instruments, which didn't benefit the market itself. Product information and risk disclosure are in fact essential for the integrity of financial markets, and therefore, transparency is the most essential tool investors have in their appraisal of any investment. As a conclusion, both the lack of transparency and the asymmetric information worked against the proper functioning of the market economy. At the same time, the inconsistency of the globalization of financial market and the national request to govern it with regulation and supervision proved to be inadequate to prevent the crisis. This approach revealed once again that today still many people are still linked to the model provided by the Westphalia Treaty of 1648, with its narrow conception of the nation-state model. This conception disregards any consideration for the international policy and cooperation, ultimately indispensable to face the opening of the markets and its progressive liberalization. In this scenario, the financial crisis spread out in the market after the failure of Lehman Brothers, with an impressive contagion never experienced before. We have been severely hit by the devastating destruction of systemic risk, a notion discussed in textbooks, but never realized in such a big scale. Furthermore, this has been the first time we have experienced a crisis not stemming from the real economy to the financial sector, but exactly the opposite. In fact, while many of the risks which played a role in the previous crisis were identified by central banks and academics in the past, nobody this time around paid enough attention to the way this risk could have combined and reinforced each other to produce, indeed, the systemic risk. In the words of the ECB President Jean-Claude Trichet, quote, "Systemic risk can be defined as the risk that financial stability becomes so widespread that it impairs the functioning of the financial system to the point where economic growth and welfare suffer materially. The crisis that we have been experienced over the last 3 years is an overwhelming case of materialization of systemic risk," unquote. The factors which produce such risk stem from the failure of the functioning of the financial market, from endogenous imbalances, and from a sizable unexpected event such as the failure of Lehman. Furthermore, having been concentrated mainly on individual risk and not enough on interconnections across intermediaries and markets, regulators and financial operators around the world were all caught by surprise. After the collapse of Lehman, the financial market stopped functioning. The complex and dynamic network among major intermediaries became suddenly fragile and exposed to increasing risk. This mechanism, which in good times was useful and efficient to process transactions and pass risk to the system, became itself a dangerous channel of instability worldwide. Risk aversion and uncertainty increased. Transactions dried up together with international liquidity, and investors were rushing to unwind at whatever cost their positions with adverse consequences at global level. Uncertainty about the solvency of their counterparties led financial institutions to seek liquidity unwinding their positions in many markets. The result was a dysfunctional money market and severe uncertainty throughout the financial system. Maturity mismatches between assets and liabilities and the disappearance of the secondary market, which suddenly created illiquid assets, amplified the effect on the intermediaries with a powerful feedback and amplification that became severe and widespread. Banks became risk adverse, and their attempts to sell at any cost unwanted assets to strengthen their capital bases amplified the financial shock. Funding and market illiquidity seemed to reinforce each other in a vicious circle. The speed of the contagion has been impressive due to global financial integration and the technological advancement which have been perfected during the years. One factor emerged clear and essential: the collapse of confidence, which is the root of a market economy. The lack of confidence indeed spread out in the financial market, questioning its capability to assess assets and liabilities. Facing a new scenario of violent and dramatic changes in the financial system, a sharp reduction of trade, and a free fall in the economic activities of the industrial world, a new effort had to be originated to tackle the systemic risk. To contain it, supervisors need indeed to have a better understanding of the functioning of the financial system, an appropriate knowledge of the risk contagion, together with the understanding of how imbalances can be spread out in the markets, creating macro shocks. The points under review have been the request of more transparency, a better regulation, the research of less cyclicality in the financial system, and less short-term policy for individual institutions and for the financial system as a whole. The top priority on the agenda for the global market dimension is now an aim: financial stability. If the soundness of each individual institution does not ensure that the soundness of the whole financial market, and if the credit, market, and liquidity risk are in fact linked, then it is necessary to have a more global and macro-prudential supervision approach with the application of the financial stability framework. With this concept, we should avoid major misalignment of asset prices that can threaten markets and the real economy. In the supervisory framework, this approach has produced a definition of regulatory capital, its quality, a new introduction of capital conservation buffer, additional layer of protection, the strengthening of the risk coverage of the capital framework for securitization, trading, and counterparty credit risk, a planned introduction of a non-risk-based leverage ratio to contain the build-up of excessive leverage, and the liquidity risk framework to improve the resilience to liquidity shocks. No doubt, negative expectations have played an important role in the unfolding of the crisis. Weaker and negative expectations of lower future income may favor shift in future spending. The risk here is that this process becomes self-fulfilling by reducing spending and unemployment and by increasing income uncertainty. Likewise, we have to understand that the systemic risk was associated with essential components of the financial system: instruments, markets, and institutions. Furthermore, the crisis has revealed in the world of BIS, quote, the strong interdependence between on-balance sheet and market-based intermediation. Institutions depend on market for revenue generation, risk management, and funding, while market functioning depends on institutions to provide market-making services, securities underwriting, and line of credit. These interdependencies between market and institutions were showcased by the difficulties that institutions faced in funding their operations in illiquid markets, and the problem created in the functioning of markets when the participating institutions were under stress. Heightened concern about counterparty risk led to a seizing up of markets and undermined the liquidity of portfolios and firms' funding strategies, causing large losses. An important message from the crisis is that the stability of both channels of financial intermediation is supported by a common capital base, unquote. The crisis of 2008 represents the consequence of global macroeconomic imbalances in savings, investments, and large current account deficits, the accumulation of excessive debt and leverage, excessive credit growth, excessive complacency for risk, and a consequent under-evaluation of its worldwide effect, together with growing financial innovation, information asymmetries, and regulatory failures. Contrary to the motto of the Greek culture, written on the front of the Apollo's temple in Delphi, nothing in excess. It seems that everybody forgot in the past years this extremely important message. Moreover, we have to recognize as well that the crisis precipitated after the Lehman failure with the materialization of systemic risk. This risk materialized, besides the above-mentioned factors, with the disappearance of confidence in markets. The most essential tool of confidence was in fact buried under the widespread uncertainties which dominated the market. The disruption of the financial system passed to the real economy. The financial system ability to channel savings to the most productive investments and to support risk diversification and portfolio management was dramatically damaged. Its reputation was at stake. A sound economic growth needs an efficient financial system. Without a doubt, we are living extraordinary times with a huge ongoing deleveraging in the markets. And while we should accept, in the words of the BIS, and this for me is the most important point, quote, that the modern financial system is immensely complex, possibly too complex for one person to really understand it, it is essential to keep in mind that the new financial system must take better account of our inherent, limited ability to understand complex processes and to foresee their potential for failure, unquote. Let's not forget, however, that the future is always open and it is for us alone to forge it. Working for a better tomorrow and a better future is not only hope, it is first our duty. Thank you for your attention.